getting cruising too. So we'll give that a minute to technology. The speed of light isn't what it used to be, but we'll let it get going here. And we look like it looks like it's going good. I'll turn that volume off. And here we go. So I'll go ahead and share my screen, give you all the presentation. So exposing the $1 trillion payment matrix, 5 wealth draining lies that keep you chained to your job until you drop that. It's kind of a pretty brutal title, but it's the truth because what if you've been following us for any period of time, then you know that the way the banking system works isn't designed to be our friend. It's designed to drain us of all the wealth we're producing. And we're going to talk about the 5 keys or the 5 lies that keep us imprisoned in this payment matrix that is simply a banking system designed to drain all of the wealth it can from everyone it can. So we'll go ahead and get started. See what the heck this is all about. There are 5 wealth draining lies that we're going to cover tonight. One is the millionaire lie, and this is the one that most people never stop to think about. What I mean by that is if you are a working individual in this country between the ages of 25 and 65, you're going to generate a big chunk of money. So the thought of what a millionaire is been kind of distorted by what you see on the cover of People magazine, all these multimillionaires. You are a millionaire in the making. We're going to talk about that. And the budgeting lie. This one, if you've ever been listening to me, if you've been listening to any of our stuff, I have a problem with budgeting because, as you'll see, budgeting is one of the reasons people wind up broke when they are ready to retire. And then there's the good debt lie. The numbers on the good debt lie are laughable. The fact that they call this good debt should be outlawed. It's, in my opinion, it's criminal, and you'll see why when we get there. And then the pay yourself first lie. This is such a misleading idea that is so inapplicable today that you'll see exactly what I'm talking about when we get there. And then the more money lie. This one a is when everybody's on the path to there. Everybody wants to make more money. We're going to talk about what more money really means and how it can actually be dangerous if you don't know what you're doing. And then we've got a bonus lie. I don't know if you really call lies a bonus, but it's called the college funding lie. I'm going to talk to you about what most of the gurus out there are talking to you about how to save for juniors college education. When you see the numbers on this, it'll speak for itself. So let's go ahead and get going with the millionaire lie. And this is what I meant by you're generating a ton of money during your working lifetime. According to Zippia.com, people are making on average $2.7 million between age 25 and 65. So you're somewhere in that range, $2 to $3 million. So the idea that you to want to become a millionaire, the process of becoming a millionaire is something you're already in the middle of. If you're working and you're generating income, you're generating wealth right now. The problem is nobody's ever been taught until we came along on how to actually accumulate some of the wealth that you've been generating. When you think about how much you've made over the past decade, you've been working for 10 years, gross income. If you have a household income, like the average family of four makes close to $100,000 a year. Over the last 10 years, that's $1 million. Over the last 10 years, do they feel like millionaires? If you've made $50,000 a year for the last 10 years, do you feel like you're halfway to becoming a millionaire? Most likely not. And that's what I mean when I say you don't have a wealth generation problem. What you have is a wealth accumulation problem. Because as we go through this presentation tonight, you're going to see why it doesn't feel like you're a millionaire in the making and why you should. Because that's what you are. Right now, you are in the process of generating millions of dollars in wealth. And the secret is going to be how you can accumulate some of the wealth you're already generating. And the question sometimes comes up is, well, if I'm making so much money, where's it all going? Well, these two industries are robbing us blind. First, we have the life insurance industry. And this is from a mid-year report last year that the life insurance industry has cash and invested assets of th $5 trillion. Okay, that's 5 trillion is 50,000 billion. Think about that. Okay. So when you think about buying life insurance, the biggest issue with life insurance, and I've been telling people this for over a decade now, is that everybody buys it wrong. And the reason we buy it wrong is because we're trying to say in the nobility of taking care of our family, want to make sure that you protect your loved ones in the event you pass. Well, when it comes to buying life insurance, you're not the only one trying to protect income. Life insurance companies are as well. And when you apply for life insurance, you have to pass through underwriting. Bottom line is, if they were paying out death benefits a lot, then they wouldn't have $5 trillion when you consider when you buy a life insurance policy, how much you pay versus how much they're on the hook for. They're pretty good at making sure they never have to pay out, or I should say, rarely have to pay out any type of death benefit. And that's where a good chunk of money is going. But that's just a mere fraction of what's going on in the banking industry, because the banking industry, according to the Federal Reserve, has over $24 trillion in assets. The question is, whose money is that? Where did all that money come from? Because when you think about what you do at a bank, you just put your money there and you use it to do stuff, and you're usually paying bills, paying debts, making debt payments or whatever. If the banks were doing something that were to our benefit, how did they wind up with $24 trillion? And most of the people that we meet with and have been meeting with for 3 decades, how come they're all basically closer to broke than the millionaires that they should feel like they are? And so that's what leads us to this point. Right now, I like to joke, I'm like a short Italian Morpheus in the movie The Matrix. Okay, I'm the payment matrix Morpheus, and I'm going to offer you a red pill and a blue pill tonight. And if you've seen the movie, which just about everybody has, the red pill is really what you should be choosing, because if you choose the blue pill, you just continue on in blissful ignorance when it comes to personal finance. The thing about personal finance is it's been overly complicated, and tonight, hopefully, we'll be able to simplify that for you a little bit. All right, so the budgeting lie. Budgeting lie has three problems: the focus trap, the income corrosion trap, and the purpose trap. The problem with budgeting is that, first of all, you're thinking of in terms of, I got a budget because I want to make my payments. And then whatever's left over, we have a party, right? So you're thinking in terms of making the payments with your budget, and hopefully you'll have something left over to put towards your future. Well, this is uh, an example from one of my clients from a while back. She had about, we'll call her Susan, okay? Susan had about $400 left over, and she was very excited about having that much money left over. She was a single mom. She was making payments on her house, her mortgage, her car payment. She had a student loan she was paying off. And this is where you begin to see how it's difficult to feel like the millionaire in the making that you truly are. Because when you understand, when you're focusing on the leftovers that you have, nobody is, I should say, until you see this calculator, which I'm going to tell you how to get a copy of it at the end, so stick with me. She had, of her income, 12, or I should say of her payments, $1,200 was going to interest. And the thing about interest, if you're not clear on this, it's all profit to the banks. So here she was celebrating $400 without knowing that 1,200 of her dollars every month, they weren't going towards the principal balance of any of her debts. This was pure profit. So she was, and her budget was profiting the banks 3 times more than she was profiting. And that's because the focus trap gets you thinking about the wrong numbers, the one on the bottom. And that's not where you need to be. That's not where you finish. That's where you start. When it comes to the income corrosion trap, I put together a sample family that's based on years of working with folks and research on different statistics from all kinds of different government agencies. And the Fortunato family, they bring home $6,600 a month. They have total debt payments of $3,133 a month. After the payments, they have 600 bucks left over. Okay. So let's see, they're celebrating this 600 bucks they got left over, just like Susan. These folks, on average, the average family of four is paying 3 times more profit to banks. This is where the income corrosion happens. You're paying $3 to the banks in profit for every dollar on average that you're putting towards your future. I don't know how you feel about that, but I believe that should be switched around. And that's what we're here to talk about tonight. And then here, this is probably the biggest trap of the budgeting scenario and budgeting strategies of all. I call it the purpose trap. You work hard, you make money, you pay bills. This basically, without knowing, places the purpose of your income to make payments. But that's not what the purpose of your income should be. The purpose of your income, yes, it is to make payments, but that's where you start, because the purpose of your income must be to replace your income. Because here's something that's difficult to understand while you're working. While you're working, income is a renewable source. Retirement is an age where you begin to get older. Hopefully, you have enough where you don't have to work anymore. But if you're in that situation and income's not a renewable source, and you're not sitting on a pile of cash that you can supplement your income and have the gold, some gold for your golden years, the biggest reason for that is because people put the wrong purpose on their income. When you think in terms of how do I use my income to replace my income, it changes everything. And so as we keep continuing, we're going to talk about the good debt lie. And this is where this should be outlawed. This is criminal, in my opinion. Let's take a look at a simple example of a $300,000 mortgage at 6.75%. It's a 30-year mortgage, payments of $1,945.79 a month. What most people don't realize is how amortization tables work. And this is the amortization table for this particular loan, this mortgage. In the first 2 years, after year one, after paying almost $24,000 that year, $20,152.29 went to interest that year. In year two, $19,929.67 went to interest. Look at these numbers. Total payments over 48 grand, and over 40,000 of it went to paying interest. And again, interest is profit to the banks. Oh, and you put up 48 grand, and what did you get in return? $8,562.79 in equity. Do you think that should be legal? It is. Total payments in the first 7 years. This is where most people, when it comes to a mortgage, according to the National Association of Realtors and like mortgage statistics, people will, on average, refinance or move in 7 years. So in the first 7 years of the mortgage is a real key time. When we're talking about this $300,000 mortgage at 6.75%, they make $136,445 in total payments in the first 7 years. Principal reduction, $27,638. Interest paid, $135,807. That's like getting a negative 56% return on your income. You put in 136 grand, you get 27 grand back. If I were to ask you to give me $1,900 a year, and in 7 years, excuse me, $1,900 a month, and in 7 years, I'll give you back $30,000, you would never do it. But when you put this in the mortgage, you wrap a mortgage around it, people are begging to, oh, please approve me. And they're happy to give up of the $136,000. They're happy to give up all that money in interest. It's insane. And they call this good debt. That's just ridiculous. That's the numbers speak for themselves. When it comes to pay yourself first, this comes from a book called The Richest Man in Babylon. It was published in 1926 by George S. Clason. And what he talked about in that book was that you can work for money or money can work for you. Now, I don't know if you can follow this timeline, but 1926, that's almost 100 years ago. We're coming up on the 100th anniversary next year of this book being published. What has changed in our economy and in our financial culture in the last 100 years? You think there's been some changes? Of course there has. There's been a lot of changes. And so when you think about this, this strategy is came from the silent movie era, okay? And there is one thing that this strategy does not address. It's called the third option. Now, when you're in debt, money is working against you. And so to prove this, I have something I call the debt dollar drain. Debt dollar drain basically shows how much people have to generate to pay off their debt when they're paying themselves first. Because what happens, if you think about that budget we just talked about, and the Fortunatos had $600 left over, or Susan, she had her $400 left over. If that's all she's got left over, then she's making minimum payments. So if you're taking everything after all of your bills and living expenses have been paid, and you're taking that and you're going to pay yourself, quote unquote, first, technically paying yourself last, what does that mean? You don't have much cash flow to get out of debt. You're making minimum payments. The Fortunatos scenario, if they did that, they have total debt of $251,000. They have $3,133 a month in payments and if they took 10% of their take home pay, let's say they came up with an extra 60, they put 660 away every month. If they did that for 30 years, they would have at 7.13%, they would have $826,000 in change. I come up with that 7.13% because that's a number from Dalbar Inc., which is a very well-respected research firm that does a lot of studies on personal finance and money and all that good stuff. And what they have found is that over the last 30 years, as of I think it was 2023 or 2024, their most recent report, the average rate of return for the average investor is 7.13% before taxes. Okay, so if they put 660 away, and let's say they put it into like a Roth IRA, they were able to do that. They got 826 grand. That's not bad. But the debt dollar drain, they'll pay nearly $900,000 to pay off their debt. If they never moved, never refinanced, never added to their credit cards, never bought new cars, they would have to pay $900,000 in minimum payments for all that debt. Well, already they're at a loss, right? Now, this makes it even worse. To bring home 900 grand, they've got to gross $1.25 million in gross income just so that they can bring home enough to pay their bills. So this pay yourself first philosophy has them losing about $400,000. Where's that come from? Now, let's take a look at this. This is what the debt dollar drain is. They have to earn $1.25 million and they got $300,000 in debt. That's $4.97 they have to generate in gross income for every single dollar they have in debt. What happens when you get on a treadmill moving at 5 miles an hour and you're moving forward at 1 mile an hour? You get launched off the back. This is why, when it comes to the traditional way of doing personal finance, it seems so difficult to get ahead. All these numbers are stacked against us, and no one has ever taught us that. This is the how the payment matrix works. It's got all this stuff working for them, but like we saw with the life insurance industry and the banking industry, they're not doing what they're telling us to do. If they were, they wouldn't have a combined nearly $30 trillion in assets. The more money lie. This is where the payment matrix wants you. And they want you generating more income. They want you earning more money, but they never tell you this simple fact that your income is a shovel. And you have something called lifestyle inflation, where the more you make, the more you spend. Think about it. Think in the last decade. Do you have you made more money? Are you making more money right now than you were 10 years ago? We had that blip in the equation, or I should say blip on the calendar of what happened during COVID. But the bottom line is most people are making more, But what happens when you make more? You get that you get a new house. You had a $300,000 house that you were paying $1,945 a month for in 7 years. You got 25 or 27, whatever it was, $1,000 in equity. You lost a whole ton of money in interest during that time, and you took the meager bit of equity you've got, put that towards a new house, and you got a new home. So what happens when you make more money is your lifestyle winds up growing as well. And that just means you're digging yourself a deeper hole because your income gets bigger. And it's also shrinking your net income because as you make more money, your tax bracket increases. So this is a trap that the payment matrix wants you caught in. It wants you to continue to make more money. Why? Because take a look at this fact. Banks own your debt. And what happens to debt, you've probably heard of DTI or debt to income ratio. The debt to income ratio is a metric that is used to determine if you have if you can get a loan. And the talking heads will tell you that 36% or less is healthy. The Fortunatos in their scenario, they have 34%. I think it's like 34.2% of a debt to income ratio. So what does that mean if they start making more money throughout their working lifetime? At $89,000, that's $30,000 in annual debt payments, or 25, 26 a month. At $268,000, that's $91,388 in annual debt payments, or $7,615 a month. And if you remember in that how much interest are you paying calculator, how much of that monthly payment on average is profit or interest for the banks? Now it's easy to see where they're getting their $24 trillion from, isn't it? This is why you have to have a different perspective on what you do with your money, because the payment matrix, you're paying up to 50% or more in interest dollars every month. And as your lifestyle, uh, as your income increases and you experience lifestyle inflation, you're never going to stop paying them 50% or 50 cents on a dollar every month. This is why it's insane to think that you can follow these rules and have the progress, not only that you think you should, but the progress that you deserve in your personal finances. And then when it comes to college funding, this is what most people think about. They think about, I got to start saving for junior's college education, ASAP, right? What do? You find a 529 plan. How do I know this? Before I knew about what we're talking about tonight with private family banking, our kids had those. What does this result in? Now, thinking in terms of the Fortunato family, if they are going to try and save as much as they can for junior's college, and let's say they go all in with the $600 a month, or I should say 660 a month, and they did that for 10 years. Junior is 8. He's going to start college in 10 years. At the 7.13%, they got $115,000 in money for junior's 4-year education. But if we go back here, what did we say? This results in they have debt. Whoops. Come on, computer. Let's try that again. There we go. They're carrying their debt throughout junior's college career. And not only that, but if they have $100,000, give or take, for junior's 529 plan, that's got to be reported on the FAFSA, which determines how much of financial aid junior will qualify for. Here's a hint. People with that kind of money don't get as much as people who have nothing saved. Okay. So now, like I said, they got 115 grand. That FAFSA is going to be showing that they have a lot more than most folks, most kids, and they're not going to be able to get as much aid. A better way is to eliminate debt. It liberates. Now, this is the deal. They don't look at cash flow, they look at income. But if this family was debt free, the Fortunato family was debt free, they get debt free in 9 years and 3 months with our plan. That's $37,000 plus every year available for junior, because that's 31, 33 a month. Plus, they have $150,000 over the 4 years. That's 37,596 times four. That's way more than they had with the 529 plan. And if they follow our plan with the private family banking, they have inside their life insurance policy, which, by the way, does not count towards the FAFSA, they have over $67,000 in tax-free cash. Combined, they've got over $200,000 that they can help Junior with. And Junior will qualify for as much aid as possible because none of these resources are reported on the FAFSA. They have zero debt stress. And even if Junior starts college before they're debt free, let's say they started it, you know, halfway through, if Junior was 14 and 4 years later, they would have, I believe it is around $1,500 a month and somewhere around $28,000 halfway through or somewhere thereabouts. And again, it's not going to be money reported on the FAFSA. So this is what we want you to understand is that the payment matrix has all these lies that you're being told to follow. You're being told that you don't make enough money, you got to go make more. As soon as you do, your lifestyle inflation hits and you start spending more. You get that bigger house, the nicer car. You go on fancier vacations. And all the while, these metrics, these numbers are numbers that none of the banking system individuals or institutions want you to know about. All right, so what now? This is where we're going to talk about. In many times, you go to these webinars, and a lot of times, this is where you get hit with some big pitch. I'm not going to do that tonight. Tonight, I want you to have a chance to get a copy of the How Much Interest Are You Really Paying calculator and the exclusive YouTube edition of my new book, Transforming Payments into Prosperity. These two tools are, well, first of all, that calculator is like I like to call it a payment polygraph because when you put your numbers in, you're going to be blown away and not such a good way, how much interest you're paying every month. And then the Transforming Payments into Prosperity exclusive YouTube edition gives you a full understanding of what the payment matrix is, how it works, and why you need to escape. And it also goes into what we used to teach was that debt snowball method. And actually, we taught it. John started teaching it in 1991. He was the first to publish it. Others have come along after him, but he's the godfather of debt elimination. And when you look at what the snowball method does, very, very life-changing, as you know, maybe you don't, but we've taught 3 million people that up until we found out what private family banking is all about. There are three things that are not so great with the snowball method compared to the private family banking method that you'll see in the book. So, how do you get those? Very simple. All you got to do is text Red Pill Me to 602-357-8249. All right. So now if you have questions about what we just covered, where's my stop sharing? There it is. So if you have questions, in your Zoom window, there is a little Q&A, a uh, little bubble thing. It's actually a square. It's got a question mark in it. It says Q&A below it. Go ahead and type questions in there. If you have any questions about what we talked about or anything that you'd like to, you have something in mind that maybe wasn't related to what we covered tonight. That's what we're here for. We've got about 25 minutes, and I'm happy to spend those with you, answering any questions you may have and helping you in any way I can. That's what tonight's for. And if you do have a question, type it in. Click on that little Q&A thing in the bottom center of your Zoom window. Type your question in, and we'll get to that. Otherwise, if there are no questions, we're going to be happy to give you guys back the rest of your Tuesday evening. So I'll give you guys a minute or two to type if you have any. And if there aren't any, we'll let you go, get you back to your Tuesday evening. All right. I'm looking, I don't see any. Alrighty then. Well, if that's the case, I must have really done a great job. So appreciate you joining me here tonight, and I hope that you have a great rest of your week. And we'll do our next Red Pill Tuesday on August 26th. So we'll see you in a few weeks. And got any questions? You should know how to reach us. Info at smartestwealthsystems.com, or just text, as I said before, Red Pill Me to, what's that number again? 602-357-8249. All right, folks, I hope you have a great night. If you have questions, let us know. Otherwise, stay cool wherever you are, and